Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Welcome to The Bigger Picture. Now, a complete global market meltdown might be one way to describe the current economic environment that we're in right now. In every corner of the financial markets, we're seeing stocks to bonds and commodities, and investors just sending one message to Donald Trump. The trade war that he unleashed is threatening to set off a worldwide recession, and it is coming in fast and hard, hammering stocks prices in Asia, Europe, and the developing world. It hit the US the hardest, worsening on Friday after Federal Reserve Chair Jerome Powell said that the trade policy shift is likely to slow growth and spur inflation. Now, if we look back at how markets have performed, we've got the Dow Jones posting back-to-back losses of more than 1,500 points for the first time ever. The S&P 500 dropped 6% on Friday. That's one of its worst performance since the outbreak of the pandemic back in March 2020. The Nasdaq Composite also entered a bear market on Friday. So how should we be making sense of all that's happening in the stock market, and where can investors find safe haven amid this turmoil? We're going to find out with Kyle Rodda, the Senior Financial Market Analyst at Capital.com. Good morning, Kyle. How are you doing today?
Good morning. I'm doing reasonably well, thank you.
All right, Kyle. Now, funnily enough, the U.S. stocks actually started a week on a strong note, advancing on speculation that Trump's long-awaited plan would not actually be as aggressive as he had hoped for. But those hopes were dashed on Wednesday when he rolled out tariffs on some 60 countries, including China and the EU. So perhaps give us your take on the overview of market reactions on Trump's tariffs.
Well, there's two layers to this. There's first, the absolute level of tariffs in aggregate was probably a bit higher than expected. Obviously, the tariff rates were specific to individual trading partners, but if you obviously average them all together, they were about 20%, and that was on the high side of what markets were expecting. So first of all, the markets had to price in a larger than expected growth shock. The bigger issue, though, is the fact that the announcement did very little to ease the uncertainty about the trading outlook or the outlook for trade policy, and in fact, probably made it even worse. There's a couple of layers to that. There's the fact that there appears to be a very strong drive by Trump and his administration to continue to push for policies that disrupt global trade, restructure the US economy, and are increasingly protectionist. There's also the sense that he's not particularly concerned about the economic consequences of doing so, or stock market consequences for that matter. And finally, there is the very non-linear dynamic emerging of tit-for-tat tariffs, which obviously set off the latest sell-off that we saw on Friday night, and the threats that any kind of response to the US's tariffs will be responded to with even higher tariffs from the US as well. So we're in a highly uncertain environment, an environment where growth looks like it's deteriorating rapidly, and even still this morning, I suppose fresh off the golf course, the US president suggested that he is sticking to his guns on tariffs and that he thinks this is actually a good policy.
Yeah, I mean, just when the global markets are convulsing, President Trump actually posted a video of himself golfing on Sunday on Truth Social, and he also doubled down on the fact that the sweeping tariffs he unleashed on countries around the world are needed. It's a medicine that we need, or at least for the U.S., wanting Americans to hang tough and promising historic investment and prosperity. So, top of that, we are also seeing Trump's top economic officials dismissing investors' fears of inflation and recession. They've offered no apologies for the market turmoil that we're seeing. So, what are you reading from this latest response by Trump and his team? And if investors are in for a deeper sell-off?
So some of it is incompetence and some of it is flat out lying. If you look at effectively the way that Trump understands tariffs, his understanding is incredibly rudimentary and false. So there's that problem to begin with, and he's obviously the originator of these ideas. There's a lot of these kind of theories going around that Trump is somehow playing 5D chess, as some are referring to it, with increasingly harebrained ideas as to why he might be embarking upon this policy. I think the truth of the matter is that incorrectly, Trump thinks that tariffs like these will bring US industry back to its shores. It will increase employment in the United States once again and also raise tax revenue, which is blatantly false. Yeah. There are members within the Trump administration who would understand this, Scott Bessent, for example, but if you look at his conversation, for example, with Tucker Carlson last week, suggesting that the sell-off was mostly about a deflation in stock market multiples because of DeepSeek, and it was a Mag 7 issue, not a MAGA issue, he would know better, and he's lying to the public. That is concerning again, because on the one hand, it would seem that Trump has no understanding of the damage he could potentially inflict in the short term and long term. And then there are also people enabling these policies. At least for now, there are rumours, Scott Bessent wants out of the administration, but I don't know how well verified they happen to be. Nevertheless, the point is that if that's the end game in mind and the Trump administration wants to stick to this policy, it means further pain to come for investors, and effectively we won't see things start to improve unless there is some level of reprieve here and some sort of reversal by the White House.
Right, and pain is what we're seeing in the markets because China also recently announced a slew of countermeasures, including additional tariffs of 34% on all goods and curbs on the export of some rare earths. So tell us your take on, their latest response to the Trump's recent tariffs, and how is this likely to change dynamics within the global market space?
Well, this is where we start to talk about nonlinear outcomes and the kind of inherent chaos that emerges when, tit-for-tat measures are sort of forced to be taken, either for, economic reasons or, in the case of China, strategic reasons. And, you sort of split down the middle there, a very rough group of trading partners who are allies, who are sort of wanting to perhaps stand up to some extent, but also set tariffs that are proportionate to protect their own economies. And there's what's happening with adversaries like China, who are obviously being targeted specifically because of the threat that they pose to US hegemony, and they have to raise tariffs mostly to keep face and continue to sort of stand their ground effectively as a competitor. This is problematic because, again, this is where a level of inertia begins to kick in, especially if the United States remains adamant it wants to maintain this policy path. And the markets find it very difficult to anticipate the next move because almost inherently it's impossible to predict. That has the problem of pricing in, or leading to a pricing of greater downside risks, but also a high degree of uncertainty. The distribution of outcomes is very, very wide here, and that means lower asset prices as well because risk premium increase. So this is the dynamic that we're working towards at the moment. Again, this could change very, very quickly because at the end of the day, the Trump administration could walk all of this back, sustain some damage, but improve the outlook considerably. It doesn't look like it's the case in the moment. So the markets are having to deal with very complex dynamics, which are, again, very inherently difficult to price in.
All right. Thanks for that comprehensive breakdown, Kyle. Now, last Friday as well, we've got Federal Reserve Chairman Jerome Powell delivering his first remarks since Trump unveiled his widespread tariffs. So can you talk to us about what were some of the key takeaways from Fed Powell's recent speech, and what does this signal about what we can expect from the FOMC minutes that are set to be unveiled this Wednesday?
So I think there's three key points to take away from Powell's tone on Friday night. First is that, they're genuinely concerned, a little bit like in the 1970s, where a supply shock set off self-fulfilling or self-perpetuating inflation, that on the one hand there's going to be growth issues coming from the tariffs, but on the other side there's going to be at least a one-off price shock. And they're concerned that if they lower rates into that could potentially set off runaway inflation, probably through some sort of, through the expectations channel. The other two elements is that I don't think Powell and the Fed want to be in the position of more or less backstopping the economy when the downturn is more or less caused by problems within the government and the fiscal side, if you want to call it that loosely, of economic management. They don't want to be there to be sort of an insurance arm. And sort of as a related point to that, I do get the sense that Powell is a savvy and experienced policymaker and political maneuverer. And there is the sense that he is wanting the administration to feel the pinch of what are very unwise policies and more or less letting them find out the consequences of their own actions without the Fed's support. So given that is the case, it doesn't seem that the Fed's going to be leaping to the rescue. The FOMC minutes that we're going to get on in the middle of this week are pretty much redundant now because other than maybe some gaming out of scenarios of what tariffs could imply, they're dealing with a sort of vastly different landscape because things have changed so materially in the last 2 weeks. But the early indications are that if the Fed is willing to step in, it hasn't given us that verbal assurance yet. And it won't be until we get that verbal assurance that, maybe the markets will price in that kind of Powell put to some extent, but it doesn't look to be there at the moment.
All right, Kyle. Now, this week is also expected to be another interesting one for investors because we've got corporate earnings season, or at least the first quarter for 2025, kicking off this Friday with banks who will be reporting first. So what will you be watching out for when it comes to corporate earnings in the US front, and what other key economic data will you be keeping an eye out on?
The inflation data will be important, going back to that point about what the Fed could do, because, one issue that arose after the last PCE data, which was a bit higher than expected, is that it indicated that perhaps the price level or even just inflation itself is a little bit higher than previously thought, and that it gives more or less wriggle room for the Fed to be able to cut rates in the event of a slowdown if inflation is still a long way from target. You get that kind of stagflationary mix where interest rate cuts, either inflame inflation or, obviously if they don't cut, it inflames the growth outlook, a bit of a catch-22. So that data is going to be very important. The earnings story is changing rapidly now because it's not going to be about profit growth. It's not going to be about whether multiples are justified as they were a couple of months ago, or whether a broadening out of earnings performance is being witnessed because of the resilient US economy. Yeah. This is all going to be about earnings downgrades and whether earnings guidance gets pulled entirely. I would imagine that, especially if we cross over that kind of April 9th date where those tariffs actually get implemented on China and some of those bigger trading partners, that a lot of companies won't be able to provide any sort of guidance whatsoever, which will not only contribute to the beginning of a downgrade cycle, but also sort of compounds the difficulty in pricing in the future for market participants, because again, all of a sudden they lose another piece of vital information. So that's what this earnings season looks like, what it will be now, not much more than that. And again, because we're dealing with such systemic risk, it's very, very difficult for any economic participant, corporation or investor to escape the fact that everything at the moment is driven by trade policy.
All right. Now, just very quickly then, how should investors be positioning themselves, keeping in mind all that's happening for this week and beyond?
It depends on your time horizon. If you're long-term, obviously you just wait it out. If you're a more short-term player, I think you start to look for signals that either the Trump administration is willing to stop applying any further tariffs from here, even better, perhaps negotiating lower tariffs, or best yet, reversing course on tariffs entirely. That's when I think buying opportunities start to arise, because this issue starts to dissipate. Until then, I suspect that we'll continue to see a bit of a risk-off move. I think the risk-off move will be broad-based and more or less quite widespread, I suppose you could say, across equity markets. There won't be that many places to hide in equities.
All right, wonderful. Thank you so much for breaking it all down for us today, Kyle. Thanks for joining us this morning.
Thank you.
We've been speaking with Kyle Rodda, the Senior Financial Market Analyst at Capital.com, talking all about market reactions on Trump's tariffs and what you should be keeping an eye out on in terms of the economic front. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.